All right, picture this. You've done all the groundwork, gathered every piece of evidence, hours and hours of work. But the most critical step, it's still ahead. It really is like that final polish on a masterpiece. Today, we're taking a deep dive into something often glossed over, but it's absolutely vital. The completion stage of an audit. That's where it all comes together, where the auditor forms their final opinion. And our mission, really, is to cut through all that technical jargon and the international standards on auditing, the ISAs. We want to pull out the key insights so you get a really clear picture of what goes on at this stage. Think of it as appreciating the rigor behind those formal reports.
Yeah, and we're drawing heavily from expert materials, specifically a document called Completing the Audit Doc PDF. It lays out the core requirements and the practical things auditors need to think about right at the end.
We think it'll be pretty engaging, maybe even some surprising connections in there. Okay, let's get into it. So first things first, why is this completion stage just so important? It sounds like the finish line, but maybe it's more like the final exam.
That's a good way to put it. It's the point where the auditor steps back, looks at all the evidence gathered, reviews the final financial statements, and then has to form that ultimate opinion. And the stakes, they're incredibly high. If this stage isn't done properly, really rigorously, there's a very real risk the auditor gives an inappropriate opinion.
An inappropriate opinion. Sounds serious.
Oh, it is. It undermines the whole point of the audit. Think about investors, lenders, regulators. They rely on that opinion. Get it wrong, and the consequences can be, catastrophic. It shatters credibility. So yeah, its importance really can't be overstated.
Okay, so with that weight hanging over it, let's look at the first major area, reviewing the audit files. This sounds a bit like the auditors checking their own team's work, right?
It is, exactly. And it's a fundamental quality control step. It's required by the standards, specifically ISA 220, which deals with quality control for an audit. The main purpose is simple, really. Did we actually get enough good evidence? Sufficient appropriate audit evidence, as the standard says, for all the important transactions and balances, making sure the foundation is solid.
But what happens if, during that review, they find something, lacking, or maybe contradictory evidence?
Good question. If the evidence isn't quite there, or if things don't add up, then it means more audit work. Simple as that. They might have to propose and perform further procedures to resolve the issue. And ISA 230, the standard on documentation, is very clear. You have to document this review, who did the reviewing, when they did it, and how much they reviewed. It's all about accountability.
Accountability makes sense. Okay, so file review done.
Yep.
Next up, facing the errors, dealing with misstatements.
Yeah.
ISA 450 guides this part right.
That's the one. ISA 450, evaluation of misstatements identified during the audit. The goal here is twofold. First, figure out the effect of any errors found on the audit itself. And second, assess the impact of any errors that don't get corrected on the final financial statements.
So how does that work in practice? Do they just list out the big mistakes?
Not quite. The rule is you accumulate all identified misstatements unless they're clearly trivial, like completely insignificant.
Okay.
Throughout the entire audit, you keep this running list. And if you find some, you might need to do more digging to see if there's a bigger underlying issue. And crucially, you have to tell management about these misstatements promptly.
And ask them to fix them.
Yes, exactly. You communicate them and request that they make the necessary amendments. Often, this takes the form of what's called an audit error schedule. It's basically a list, itemizing each misstatement, showing the financial impact, and suggesting the fix, maybe a journal entry, maybe changing how something's presented or correcting a disclosure note. And then the auditor follows up to make sure management actually made those corrections and made them correctly.
Now, here's the juicy part for me. What if management says no? What if they refuse to correct a misstatement? Auditors can't just force them, can they?
No, they can't force them. But if management refuses, the auditor has a whole set of procedures to follow. It gets serious. First, they have to step back and reconsider materiality. Is this uncorrected error, or maybe a group of them together, actually material, big enough to potentially mislead someone reading the financials?
Okay, so they reassess the impact.
Precisely. They determine if these uncorrected misstatements are material individually or in aggregate. If they are, or even if they're potentially material, they must communicate them to those charged with governance.
So the board or the audit committee gets involved?
Yes. The auditor lays it out. Here are the uncorrected errors. Here's why we think they matter, and here are the potential implications for our audit report. They also need to understand why management isn't making the corrections. What are their reasons? And then comes a really key piece of evidence required by ISA 450. The auditor has to request a formal written representation from management.
A signed statement.
Essentially, yes. Management has to state in writing that they believe the effects of these uncorrected misstatements are immaterial, both on their own and taken together, to the financial statements as a whole. And a summary of those specific misstatements has to be attached to this representation. It's a formal acknowledgement.
Wow. Okay. That puts the responsibility squarely back on management for those uncorrected items, at least in terms of their assertion. So, having dealt with the nitty-gritty of specific errors, the auditor then needs to zoom out, right? Get that final big picture view.
Exactly. That brings us to final analytical procedures, which fall under ISA 520. This is about forming an overall conclusion.
How do these differ from the analytical procedures done earlier, like in the planning stage?
The techniques are similar: ratio analysis, comparing to prior years, looking for unusual trends, that sort of thing. But the context is totally different. At the planning stage, you're identifying potential risks. Here, at the end, you should have gathered enough evidence throughout the audit to actually explain any weird fluctuations or anomalies these procedures might highlight. You're confirming overall reasonableness based on everything you now know.
So it's less about finding problems and more about confirming consistency.
Largely, yes. But, and this is crucial, if these final procedures do throw up a new, unexpected risk of material misstatement, something you hadn't spotted before.
Uh-oh. More work.
Potentially, yes. The auditor must revise their risk assessment and modify their planned procedures. So even at this late stage, you might find yourself needing to do additional testing if a significant new risk emerges. The audit isn't over till it's over.
Right. And something else that often happens here, as I understand it, is reviewing the notes to the financial statements, sometimes for the first time in detail.
That's very common. Clients often finalize the notes late in the process, so the auditor reviews them for completeness, clarity, and compliance with the relevant accounting framework. Are all the necessary disclosures there? Are they understandable? And it's not just the notes. Auditors also look at any other information published alongside the financials, like the director's report you see in the UK and Ireland. They check for consistency between that report and the audited financial statements. Any material inconsistencies could affect the auditor's report.
Okay, that makes sense. Checking everything lines up.
Right.
Now, let's shift gears slightly to timing. Two standards seem really focused on the calendar: ISA 560 on subsequent events and ISA 570 on going concern.
Absolutely critical, both of them. ISA 560 deals with events happening after the balance sheet date, before the auditor signs their report. The auditor needs procedures to get evidence that any events requiring adjustment or disclosure have actually been identified.
So what kind of procedures are we talking about? Checking the news headlines.
Well, maybe indirectly. But more formally, it involves things like reviewing management meeting minutes held after year-end, reading the latest interim financial statements if they exist, and definitely inquiring directly with management.
And the timing is key here, right? You have to keep checking right up until the last moment.
Precisely. These procedures need to be performed as close as practicable to the date the auditor's report is actually signed. If you do them too early and don't update, you could miss something significant. A major lawsuit settled, a huge fire at a factory, a big acquisition, things that could materially impact the financials. Then there's going concern, ISA 570. Auditors have to be alert for potential going concern issues throughout the entire audit. But the final conclusion on whether there's a material uncertainty, or indeed if the going concern basis itself is inappropriate, is typically made right at the end, once all the evidence is in.
Makes sense. You need all the pieces before making that call. Okay, nearly there. Two more critical pieces: written representations and communication with those charged with governance. Final, formal steps.
Very much so. We touched on written representations earlier regarding uncorrected misstatements, but ISA 580 requires them more broadly. They are considered necessary audit evidence. Management confirms in writing certain responsibilities and representations they've made during the audit, and the dating is crucial. They must be dated as near as possible to the auditor's report date, but not after it. And they must cover that whole subsequent events period we just discussed. You literally cannot date the audit report before you get these signed reps.
Got it. And the communication with governance, ISA 260?
This is about ensuring the board or audit committee is informed about significant findings from the audit. Things like significant difficulties encountered, key judgments made, any disagreements with management, and critically, matters related to the auditor's independence. But it's not just a one-way street. The standard also requires the auditor to consider if the two-way communication throughout the audit was adequate. Was the dialogue effective? If not, the auditor needs to consider what actions to take.
Right, ensuring everyone's on the same page, which leads nicely to the final point, the audit clearance meeting. Not strictly required by the ISAs you mentioned, but common practice.
Very common and highly recommended. Its main purpose is simply to ensure there are no lingering misunderstandings between the auditor and management about the financial statements, the adjustments made, the final audit report, or any other key matters discussed. It's a final alignment check.
What kinds of things get covered in that meeting, typically?
It can be quite broad. Things like the adequacy of internal controls, the final list of proposed adjustments, any difficulties the auditors faced, ethical considerations, confirming the content of those written representations we talked about, maybe updates on new regulations, confirming accounting policies are appropriate. It's really a chance for a final open discussion to clear the air before the report is issued. So yeah, while it's not mandated by the standards, it's a really effective way to ensure clear communication and wrap things up smoothly. Avoid surprises later.
And there we have it. Quite a journey through that completion stage.
Yeah.
We've gone from, the deep dive into the files, checking the checkers almost, to grappling with misstatements, that whole process with management and governance. Then stepping back for the final analytical procedures, that big picture consistency check.
Right.
And those time-critical bits, subsequent events, making sure nothing slips through right at the end. Plus the final formal communications and representations.
It really highlights that the completion stage isn't just some administrative wrap-up. It's a complex, carefully structured phase governed by multiple standards, all designed to support that final, crucial audit opinion. It's about ensuring reliability and trust.
So the question for you listening is, how does knowing about this intense final scrutiny change how you look at a set of audited financial statements? Does understanding the rigor involved, the checks, the challenges, the judgments, give you a different perspective on the numbers, or perhaps on the company itself? Something to think about until our next deep dive.